All right, we're live on the YouTube. All right. Okay, well, welcome to Victor V TV. I will explain that in another episode, Victor V TV, and I think you'll get a kick out of it. But for my subscribers, all right, we're live on the YouTube. All right. Hold on. Okay, well, welcome to Victor V TV. I will explain when I'm streaming live. We're streaming live on YouTube, and I'm live out of Miami, Fort Lauderdale. My name is Victor Arocho, and in this video, we're going to talk to you about storing money and how to generate money twice. Now, I've talked about this many times, but in this case, we're going to really talk about it how with an entrepreneur, an insurance expert, and how it can benefit auto insurance owners and insurance agencies in general. The key takeaways is going to be where the wealthy store their money and how they use it. Well, if you're an owner of an insurance agency, the objective is, I would think, is to generate wealth or have your own job. So we want you to, key takeaway is, where should you be storing the commission, the premium dollars that are coming into your company? The second is realizing that the banks take from the common person, which is the small business owner. Big businesses know what they're doing with it, but from the common people, because this can apply to common people as, when I say common people, people not of wealth, but they can create wealth. But we're going to talk to this on the business sense. So they take the money, and this is how they create wealth for their shareholders. And the third key takeaway is where you could store your money and how you could use your money to start getting guaranteed compounded interest. Okay, great. Again, my name is Victor Arocho. Welcome to the show. My guest today is Andre Urena. He is a serial entrepreneur. He is also founder of many Latin associations, helping out businesses getting into the Latin community for their products, and Latin businesses and helping them expand. Him and I are part of, and as the founder of what we call Lapa, the Latin Association of Professional Alliance. I am a chapter president out east. He's chapter president out west. We kind of combine it together. He has tremendous experience, and he's kind of going to be in for a nice little surprise, because I'm going to ask for his input and what his thought on, because I'm a certified insurance expert as it relates to debt-free life, your family bank, and I work on the insurance benefit concept on how to use money twice. So welcome to the show, Andre Urena. How are you today? You're on mute, buddy. So all of a sudden, by the way, he's you got to give him a little credit, because they're a little behind time, because he's in Pacific time. He's in California, so they're 3 hours slower than we are.
I'm here, man, but we outlast you though. When you're sleeping, we're awake.
That's true. Yeah, but when you're awake, when we're awake, you're sleeping.
Yeah.
So welcome to the show. I know you're doing a lot of great things, a lot of projects you got going on. And we're going to talk about Lapa and how we did it before, and you found it, and how you founded Lapa. So pretty much, can you give me a short little bit about Lapa and its importance to like who we target?
In the next 3 years, there's going to be so many changes in business. All that Lapa does is connects people to other people that can actually help them service their consumer better. And that's a different way of looking at organizations. Most organizations are industry driven. Ours is more like, hey, what do you need to help your customer at the best? How can you grow your business through technology? So it's a give and take. It's a B2B organization that help each other. So we help people in the financial services, from insurance to income tax preparers to real estate to mortgage, to people that do car registrations, or in your neck of the woods, they call it tags. All these things relate, and some people that have brick and mortar shops need to keep that traffic going by having tags or auto registration places, and some just go online. So it's a time for change, and our organization here is to aid that. We have an extensive network. You have an extensive network. Together we're stronger.
Excellent. So you're going to appreciate this episode and this show. And then how we could benefit, because you and I spoke about the concept of bank on yourself, infinite banking, and you kind of liked it, but the gist of it, I'm looking for more on how we could help it through our associations and our connections, and both personally and business wise.
Yeah.
So let me start with the first thing that I've been doing infinite banking or bank on myself for over a year and something, right? I have
Right.
multiple clients, but particularly I have multiple policies. So this is it's insurance, right? But it's really insurance to benefit from the banking concept. So today, for example, the average person, or let's forget about the average person. Let's focus on the insurance market, the auto insurance carriers, right?
Right.
Insurance carriers, would you agree? Now, a little bit about Andre. Andre, tell me real quick, short, please, because I want to get into the point, to the takeaways, right?
Sure.
You've owned how many insurance agencies back in the day?
500.
500 agencies, and running how much premium? Hundreds of millions of premium, right?
Yes.
Okay, great. But you were an insurance agency, so therefore you represented the insurance company. So you were the distribution channel for the insurance companies. Is that correct?
Yeah.
Okay.
In California, I call them brokers, but yeah.
Okay, great. So the insurance companies are the ones that it takes a lot of money, and I started an insurance company back in 2008 with a partner.
Yeah.
We had to raise $16 million, and then you have to have money in surplus, right? And the surplus is, in the case of a catastrophe, right? You have to be able to pay claims, right?
Absolutely.
So you can't just take people's money and not pay their claims. So the guarantee in a contract, in any insurance contract, it's unilateral. There's promises made. I'm going to pay you premium in the event that something happens. You're going to do what you say based on that contract. You're going to repair my car. You're going to give me money back for my car. You're going to pay for my death benefit and so forth. So infinite banking is no different, right? So, and the beauty about it's purely on how you're funding your money. So today, in insurance companies, the way an insurance company, most people don't really understand this. The way an insurance company really makes their money, meaning Progressive, Responsive, the company I used to be, any insurance company out there. Hence why Warren Buffett, one of the greatest investors of all time, his money really started being generated when he bought Geico, because now he has all this insurance premium. He once made a statement that insurance, particularly auto insurance, it's like being a mosquito in a nudist colony. Okay, because you get all this premium up front and you don't have to do anything until something happens. So it's a pool of money. He's able to take that money and utilize it to make key investments. Now, the difference, so again, how does insurance company make money? They make their money on what's called float. Right. And for those that understand float or don't, from our listeners, is float is the ability to have somebody, cash coming in from somewhere. And in between the time that you actually got to use the cash or put it to play, you're making interest on that cash. Is that a fair statement?
Right.
So they make it on float. Now, they also will make their money on claims and so forth. But on average, for like a company like Progressive that I know for sure, their goal as a shareholder is to try to make 4 cents on every dollar.
Right.
So that's not a lot of money. Would you agree?
Absolutely.
That's 4%, but it's not a lot of money. A lot of times, sometimes they may not make 4%. They may make a lot less. If they make more, they got to be careful because it's a regulated entity. They got to lower their rates or do something. But if they make, what happens if they don't make all the 4%? Where do they make their money?
They make their money in the bank.
Right. They make their money on their investments. So an insurance company, different like a bank, they are allowed to take premiums and their money in their surplus and put it in investments, except for those investments are called, I believe, tier 1 investments, meaning they have to be protected and they have to be liquid.
Right.
So now some insurance companies they're also able to buy assets in like buildings and so forth, but that percentage can't be high because it's not like you can sell a building to pay a claim. You have to be able to have access to that money right away.
Right.
Is that a fair statement? But while they're doing that, they're making money on it. So what they're doing is they're taking their money, putting it in a secure asset, and they're making money on that money. Right. And the beauty is, obviously, it took them a lot of money to start the business, but a lot of their money is made by other people paying premiums put into their company. Does that make
Right.
sense? Okay.
Absolutely.
Now we got that part. An insurance agency, an auto insurance agency, they get paid commissions. So let's say, just to make life easier, they get paid $1,000 premium. Let's say they get paid 12%. They're going to make $120.
Right.
When they make that $120, do you agree that money goes into their commercial?
Right.
Correct. Okay.
Right.
So that 12% is considered an expense for the insurance company. So the insurance company is trying to make their money, but they also have an expense to get the business. So now I'm going to move from the insurance company to the auto insurance guys. Okay.
Right.
I just wanted to make sure we understood that. It's funny that the distribution channel doesn't seem to do what the insurance companies they represent. And I'm going to ask you, because I'm pretty positive you didn't do it either. Now, I'm not saying that by no means in any, no disrespect or anything. It's just that I will tell you right now, I wish I knew about this concept 30 years ago. I wish I knew to tell you about this concept 30 years ago, because we'd be in a totally different atmosphere. But maybe this is what brought us together to help others, right?
Absolutely.
And tell me right now, I've learned this over a year and a half, 2 years, and I'm just continually studying it, learning it. And I'm super passionate about it, because not only for myself, but for others and for the common person, right?
Right.
Business owners. So you heard what I just said. An insurance company takes people's money and they put it in a safe investment that it's growing. Plus they're making money on fees and so forth. So they're going to make their money that way, right?
Correct.
An insurance agency takes their money, they run their business. Now, out of that 12% they make, let's say make the 120, they have X amount of expenses, and their goal is, after the expenses, you would tell me you make a profit. Is that fair? You pay your salaries, you make your profit. Now, obviously, you have to sell lots of policies, right? But the bottom line is you make a profit. But all that money is, you're directing it to where? To your commercial bank, right? And back in the day, you were supposed to have multiple accounts. You were supposed to have an operational account and a trust account.
Right.
Today they pay you as earned. So necessarily you don't have to, because they wanted you to have a bank account where you would take your commissions each month, and nobody did that. They take their commissions up front, right? So companies are paying it as earned. So now you could use it right away because it's been earned. It's either as earned as paid. As earned means you pay for a policy for $1,200. The agent earns their 12% as the person pays every month. So now each month they get a commission from the company instead of getting it all up front. But that all goes into a commercial bank. Is that correct?
Yeah, absolutely.
Out of the commercial bank, what do? You pay your expenses?
Yeah.
What do you pay? Your salaries, your
everything
rent.
that has to do with the business, right?
So, and then sometimes you have to get equipment, right?
Right.
Now, what are the ways that you would buy equipment?
You finance it, you lease it.
You finance it or you lease it, right? So when you finance and you lease it, there's interest paid on that. Who gets paid? Who gets paid the interest? Who makes the money on the interest?
Whomever lends you the money, bank or another financial institution.
Exactly. So let me share you something that I was doing before, and we can still do it. There's two concepts. When I first learned the concept of insurance benefit concept or bank on yourself, I learned it first from, getting out of debt-free life. So find inefficient dollars and start building a policy and build up cash value. So these are custom designed policies, right? They're high dividend insurance companies like Mass Mutual, Mutual Trust. I mean, you've heard of Mass Mutual, right?
Absolutely.
And these banks, insurance that insurance has been around for over 200 years.
Yeah.
Okay. Yet
in Lloyd's.
The tax code started in 1913.
Right.
So for insurance being around for so long, the companies I represent have been around for over hundreds of years, over 100 years. That means they've been through the Depression, Black Friday, all of that. So they're still in business. Don't you think there's a lot of companies that have been out of business during that time?
Absolutely. I've seen them.
So here's the concept, and right, this is what I do today, and I learned, right? All the money that someone either makes through the insurance company or their insurance agency, and all the money, any money I make from income, salaries, business ventures, right? You either have two choices. You put it into a bank, right? And that bank, what does the bank do? The bank's able to lend that money out 7 times. So the second you put money into a bank, so if you're a commercial, like when you had your agencies and you put your money into the bank, it was a
Right.
liability. Why?
Absolutely.
Because they had to give you that money if you went back and said, give me my money back, right?
Absolutely.
But they actually turn it into an asset because they take that money and they lend it out in the form of mortgages, credit cards, financing, equipment, all of that. So instead of it being a liability, now if you go to Wells Fargo, Bank of America, any of the top companies, on their balance sheet, they will have a line item under their assets, and it's actually specifically called bank-owned life insurance.
Mm-hmm.
It's called BOLI. Corporations, the top 500 Fortune 500 companies have it, and they call it corporate-owned life insurance. That's how they buy key man insurance and so forth. This way, their business is insured in case something happens to key people, but they're able to use the cash from that company. So let me show you how the concept works, and I want you to start picking holes in it or asking questions, and then tell me how that would have made a difference in all the monies you've collected. So what happens is you start, and this would go over multiple policies. As you insure yourself, you insure the bit, you have to have an insurable interest. So it could be you, a family member, or a key person, right?
What about the business?
Well, the business could be the beneficiary, but you can't insure a business because business doesn't have a life. There's no table of life. Does that make sense?
Yeah.
So it's always the business.
It's life insurance, right?
Right. So the business could be a beneficiary, right? But the business can be the owner. The business can pay for it. So watch this concept. Andre, let's just say you had your 50 locations. You collect your down payment and your premiums, right?
Right.
Now, obviously, when you started your operations, just like any business, you have to have some working capital. So if you go online and look at any franchise, they're going to say, hey, you need to have a net income of this, you need to have working capital of this, and so forth. Every business, insurance companies, and so forth.
Right.
But at the end of the day, they really start using their money based on the revenue that's coming in, not necessarily the money that they had it just sitting there in the bank. Is that fair?
Right. Absolutely.
Okay. So now you have your bank and you're able to pay your expenses. So now for every dollar that comes in, instead of going into a commercial bank, it would go into what we call a custom design insurance benefit policy, which is built upon lower levels of insurance that like a whole, it's part whole life, it's part paid up additions, which is where the most of the money in is, and then it's part term. The reason why you have the term is because the term, you're able to buy way more insurance with term, right?
Right.
And then you have insurance with the paid up with the whole life, and then you have some with the paid up additions. And what happens is the tax code 770 came into effect because a lot of the wealthy, like the Rockefellers and so forth, would use these policies, but buy a very small life policy, but put as much cash in it as possible.
Of course.
So they said, wait a second, we can't do that. So there's now some type of calculation ratio of where that the ratio of the amount of money you could put into an insurance policy has to be in combination or in correlation to the amount of life insurance that is bought. Does that make sense? Okay. So let's say in this case, you have the right appropriate amount. We designed the policy. That's why you need certified people. And by the way, people.
What do you mean by certified people? And what do you mean by this is not for everybody. This is for the people that have businesses, that have money, that have cash flow.
No, this is for everybody. It's just I'm only giving this segment on insurance owners, insurance companies, insurance agencies, auto insurance agencies, right? So I don't have to have a lot of money.
Okay.
You can do it for the common person. That's the beauty about it. That's a different segment. But because of what you and I do with Lapa and so forth, I wanted to focus on the auto insurance agencies. And since you own many of them, I wanted you to start seeing the concept and pick holes in it, right?
Right.
So what happens is now we write a policy, right? I go to you, I go, okay, great. We either take out a policy on you and you can decide two things. Here's the beauty about legacy now. You start your insurance company, your insurance agency, multiple. You had some cash, you raised some money. I take the policy out on you. Let's say that you can pass health-wise and you're in good shape back then. Everything was fine, right?
Yeah.
You're the life that we're insuring, but the policy beneficiary can be the insurance agency. So if something happened to you, they would receive whatever the millions it would be. So the insurance company keep going. Or you could have spread it between, okay, 80% of the benefit, death benefit, if something was to happen to you, will go to the insurance agency for the business, and 20% would go to your family. Right? You could spread it in any manner way. Then you could have insured you had a VP. You could have insured your VP, and you could have said to them, look, by being VP, if you stay with me X amount of time, I'm going to give you this policy worth several $100,000, right? And then you're going to get some income as you get going. But you're going to take out a policy. That's how banks do it. Instead of on a couple $100,000, that policy is going to probably be 3 or 4 or 5 million. You may be giving her 300,000, but you may be getting 2 million for the company. You got it?
Yeah.
Okay, so let's just work how the money flows. This is just a concept. So now I'm going to just stick with the money flow first. The money that you collect, you immediately put all of it into your banking policy. The second you put it into your banking policy, there's a level of how much you could put in based on how we structure it, right? So let's say in your case, at any given month, let's say you took in, I don't know, give me some numbers.
Let's say you took in 75,000.
You took in 75,000, right? So that policy, we'd have to structure it well. So you took in $75,000 in cash. You would put that $75,000, immediately put it into what we call your paid up additions insurance policy, right?
Okay. What do you mean by that?
What paid up additions is the ability to buy more insurance, except for the cash value of it. You can get all of it back, but then you would negate the policy, which would cause a tax event. But you can borrow against the insurance company's reservoirs up to like 92% or more.
Okay.
So let's just make it super simple. Let's say you collected $100,000, right?
Right.
You put $100,000 into your insurance policy, right? Now you have access to it, right? There's a cost of insurance. Let's say you have access to $92,000, right? You then borrow directly from the insurance company, right? Not from your policy. That's the beauty. You take back out the $92,000 and utilize it for your operational expenses. That's a tax-free movement. You pay zero taxes on it. Okay. You got that so far?
Yeah.
Okay. Beautiful. So now you start paying your expenses, your so forth, your salaries, and so forth out of that. Here's the beauty about that. When you deposit it, if you deposit that same 100,000 into your bank, commercial bank, and you took the 92,000 and started writing checks, right, to all your people, to all the pieces that you need to do to yourself, right?
Yeah.
The bank, first of all, how much were they paying you on interest?
Not only that, but how much they charge me in handling fees and all that stuff.
So they're charging you fees and stuff. So when you take the money out and you write checks, right? And you just say you wrote checks for 92,000, like I just asked you, right?
Yeah.
You're barely making interest. How much was left? How much was left in your bank account? $8,000.
Right.
And you were making less than 1%, maybe 1% or whatever on that $8,000. Right. Okay. When you do bank on yourself, you put the 100,000 to your bank. You take the 92,000, you put it into your operational funds, and you start using it from there. Because you're borrowing it from the insurance company.
Yeah.
Continue to make 3 to 4% on the 100,000, not the 92. What are your thoughts on that?
It's awesome. I mean, I could think of quite a few guys that actually run and own and gals that own their own agency that could really be taking advantage of this and really control their banking, control their financial outlook.
So now let me go back to do something even better. Okay. So when you go into it and then you infuse the money, you put it in there, you infuse the money into your bank. Now, I'm not a tax accountant. I'm not any of that. You could talk with your tax accountant. If it was your policy, you may be able to write it off as a capital infusion, number one.
Right.
But let's leave that alone. So now you take that 92,000 and you pay your expenses. But now you said you had to buy equipment, right? And you would be buying your equipment. So imagine if we build a policy to fit the levels, right? The premium level, so you could put in 100,000 every month, right? Or
Right.
you pay it back. So let's say now you've accumulated $200,000, $300,000 in your policy.
Right.
Guess who becomes the banker, right?
You.
Andre Insurance, the banker. So now you got to go buy copiers. You have to go buy this. You go buy them, right? But you got to be a banker, just like a business, right? You can't give away free insurance to your family, right? You wouldn't be making money, and that's not the deal. So what you do is you go buy your copiers, you go buy, but what about cars? Didn't you lease cars and buy cars through your insurance company?
Absolutely.
You see, okay, great. But all that money was going away from your insurance company, from your insurance agency. Do you agree?
You're paying interest to the banks.
So now you got a couple $100,000. Now you got to buy a bunch of computers. It's going to cost you 30, 50 grand. You go to find out how much is it going to cost me. It's going to cost me 30 to 50 grand. How much would I have to make payments for it? Let's say your payments are going to be 1,500. Okay, great. What's the interest rate? The interest rate is, 70, if you go to Best Buy, it could be 14%, right? Okay. Right. So you take the 30, you borrow the 30,000. Guess what? You're still making 4% under 200, 300,000. You understand? You never stop making interest on the money you put in.
Mm-hmm.
Never. So that means your interest keeps going like this. It never goes like this. It's not market driven, nothing. You borrow from the insurance company, you buy the equipment cash, right? But then you're lending the money as the banker to your insurance agency, and you charge them 7% because you're borrowing at simple interest, right? Of which there's no structured loan. You don't have to pay it back. You don't have to pay it back every month if you have a bad month. But if you borrowed money and financed your equipment, what happens if you didn't buy your equipment?
The bill still will come.
And they'll come and take your equipment if you don't pay. In this case, if you have a bad month, you can't pay that month, you don't have to worry about it. What are your thoughts on that?
No, it gives you peace of mind as an entrepreneur, as an agency owner.
So now you lend the money to the insurance agency of 40,000 at 7%. You're borrowing it at 4%. How much are you making?
Making 3 points.
Exactly. Plus the 4%. Oh, I didn't even tell you about dividends. Dividends are not guaranteed, but they've been paying dividends for 100 years. So the odds of them not paying a dividend is not, but that's gravy money. So now you're financing your own equipment as an owner. You're no longer sending out any dollars to anybody else. You buy that, but then guess what? Do you get a tax write-off from that 10%?
Absolutely.
So now you're writing off taxes. So what I'm doing is I'm trying to help our clients, our agencies, anybody really, because it works for anyone. But I want to stick with the auto insurance side, right? Because we know these people. All that cash. Meanwhile, every time you're putting money into your policy, the paid up additions, it's buying you more life insurance. So you'll grow it'll grow to millions of dollars. Even when you sold, you would have had that policy.
So what if I say I'm an insurance agency owner and I have that going, but also I own a restaurant?
Yes.
Separate corporation. You can still do it twice?
Oh, time out. Two things. So you can do bank. So you would take out the objective here is never going to be one policy because it never just fits. You're going to take out I have 5 policies. I know guys that have 19. Right. Okay. So 2 things with the restaurant. Andre's bank owns a restaurant. You can lend to whoever you want. I was just tying it to your own agency. I was saying, hey, look, all the money in your agency's coming in. You're going to the commercial bank and it's going out, and you're never making money on the spread. Yet your insurance company is smart enough to make it on the spread. Right. I'm saying to you, float that money, guaranteed 4% for the rest of your life, constantly compounding, right? But you could you build up enough cash. Let's say you have enough cash, you have the equipment, you're up to date, and you're constantly just putting premiums in there. Your expenses are X, but you no longer have any payments. Let me finish with the equipment. You buy equipment, you buy it for 5 years, right? So now you just paid yourself back the 40, 50,000 that you spent on equipment.
Right.
You have all your money back that you spent on the equipment. Do you agree with that?
Absolutely.
And guess what else you have? The equipment.
The equipment. Yeah.
Okay. Let's do it with the car. You used to lease cars. Leasing, I learned, is the worst, right? We all
Yeah.
leased. We loved it, right? But let's say now you go and you have 100,000, whatever, and you go, you know what? I'm going to buy me a $70,000 BMW through the company, right? Okay.
Right.
So the company buys it through the policy, borrows it, pays it back. What are the payments? $700, $800. You pay back that on interest. So be your own banker, pay it back, right? You pay it back over 5 years. You just recouped all the money, the 70,000 you paid, plus the interest you charged to the bank, which is a write-off to the company, the insurance agency, right? You now have all your 70,000 back, plus what? The car.
Yeah.
So now you have the asset of the car that, let's say it's 70, you know how cars go down. Let's say it went down to 35,000.
Right.
So you have a $35,000 asset plus $75,000 back.
It's amazing.
Okay.
Yeah.
Does that make sense?
It not only makes sense, but now what does it take to sign somebody up, or for somebody to actually have like a projection or presentation as to what is it that they could be saving and or making?
Oh, that's easy. I'm going to give you that right now. So one takeaway is where to store the money. So I want to make sure we're covered the takeaways. Where do the wealthy store their money? Right? The wealthy, what I was reading about the wealthy is they call it buy, borrow, die. That's why they don't pay taxes. They're always borrowing, right? So they ain't paying taxes, which they're always borrowing, but they're borrowing against their own policies. They're borrowing themselves. Now, people confuse this with whole life. This is a component of whole life, but it's not whole life. Just so you know, for people like myself that sell it, and you know, I'm teaching you as well, we give up 70 to 80% of our commission. Okay. Right. And the reason being is if you sell a whole life policy by itself, you get your full commission. When you sell a custom design policy that has the 3 parts, it has the whole life portion, right? So you have it for life, but it's the smallest amount. You have the paid up additions, which is where you bank all your money, right? Yeah. You have the term to give you the ability to bank all your money. Well, we only make our money on the paid up on the term and on the whole life. We make 2% on the big part of it. The other agent doesn't want to sell that. One, they don't know it. And 2, they don't want to surrender their commission. The reason I do it is because once I had a guy like you that had all these businesses, you're going to take out 6, 7, 8 policies. Right. And I'm able to help you grow your business. You're going to be like, dude, this is a mastermind. The other thing is I'm frustrated because I wish I would have known this. If you would have known this and I would have known this 30 years ago and all the money that we made, right? And we've made, not to say anything, but we've made, the average person makes $2 million in their lifetime, right? During a whole lifetime. You think like 60,000 multiplied by 30 years is going to get close to $1 million some dollars. You and I have made several million, right? So it's not that no one's made millions, but we've made it a lot, right? Right. If that all went through our own bank, we'd be in a different position today.
Yeah, absolutely. You have to be disciplined about it.
And our family, yes, that's the key. Is all you, man. Key word is discipline. You're not disciplined, this isn't for you. So, so my point being is that money, all you're doing instead of running it through another bank, run it through yours. But it's considered it's really a banking policy that has a life benefit. That's it, right?
Yeah. So I love it.
So that's that, right? So I wanted to answer that. So where do they store the money? The banks, the common person, create wealth for their shareholders. Why? They're making money for their shareholders. So imagine you and your partners, right? You're putting that money in there and rolling it out, putting it in and rolling it out, putting it in and rolling it out, right? Paying yourself interest, taking out multiple policies. Well, aren't you creating interest? Now you have a line item for investment income. Did you have a line item for investment income in your?
Yeah, absolutely.
You did? What was it for? What were you investing in?
We had a bunch of different, like, for example, I would invest on the guy that makes the counters. So then I have another business going for that. You know,
right. So you were investment in businesses, not an investment income.
No.
Right? To me, investment income, if you see that in a line item insurance company, is the money they make of how they're using their money. So they're putting
insurance agencies are a little different. Yeah.
What?
Right.
Yeah. So what I'm saying, the investment income would be that 3 to 4% compound that you're making every year. Mm-hmm. Without worrying about whether that business deal is going to go well or not. Do you agree?
Right. Yeah.
Like,
and then
it was smart that you were investing. Don't get me wrong, but it wasn't really that investment may or may not have gone to the of your insurance agency. It was going to outside investments that you were doing through the generation of money of your insurance agency. Is that a fair statement?
Oh, yeah.
Right. This one is on your line item that's going to come. And by the way, the investment income and the dividends, they're all tax free.
Right.
All the money,
life insurance is free.
All the money in the policy is untouchable through bankruptcy and IRS. Imagine that.
Yeah, so gives you security.
Look at all the protections you have, right? So boom, where you store the money and guaranteed compounded interest. I'm telling you now, in a custom design policies, there's about 10 companies in the country that use it, and only about 95% of the people will use it. So now your question, how does someone go about it? Well, we set up a strategy session. Right in this video, I'll put in the link where you could see a strategy session with the money multiplier. Number two, I have a conversation with you to make sure this is something that you're interested in. And it's a paradigm, it's a mind shift. You understand? Right. But think about it. Who's more protected, the insurance company or the banks? Banks have gone under, right?
Right.
Okay, banks had to get bailed out, right? Right.
Absolutely. All the time.
Life insurance companies been around for 200 years. I think they've done pretty good. So what we do is you got to qualify, right? We got to be able to, I can't sell you anything. You got to qualify. We got to find who's the best insurable interest. And by the way, you can insure anyone from 70 to whatever. You could get started with $100 to $10,000. You understand? You could start with a certain amount and then use it. You know, what's changed me, I was only using it for extra money I was paying to either my mortgages or debt or whatever. Now I'm running all my income through my banking system. And then I'm taking.
So wait a minute. So your mortgage goes through your own. You bank your own mortgage?
I will, but not now because it's only been a year. This is not a get rich quick scheme. It's about generating income, but the faster and smarter you're able to do. So the objective is to be able to store your money where you're getting guaranteed compounded interest.
Right. Taking
that money and making more money than what you are on paying simple interest. And you know what simple interest, for those out there, simple interest is super simple. Simple interest is if I borrow $1,000, just let's say the interest is 5% for just math, right? The only interest I'm paying is $50.
Right.
Okay. And that's it. Compounded interest is whatever you owe, they're going to constantly, look at your credit card. Every single day, they're charging you interest on whatever you have your balance on. And sometimes they're charging you interest on your interest.
Right.
Does that make sense?
Yeah, absolutely.
So think about it. If you're no longer paying, if I'm taking back the interest, like right now, my policy's gone up, I'm about to pay off a big debt. Right? Not only am I making my 4%, but do you agree if I'm paying 14 or 20% to a credit card company, did I not just recoup 20% of my money?
Absolutely. Absolutely. Okay. No, it's a great idea. And it's not only a great idea, but it's a great working concept. And I hope that we can bring it to a lot of the business owners at Lapa and people that we know, because they will truly be saving money. The key thing is discipline, and it's a long, like you said, it's not a quick money maker. It's just a long term. You actually start making money right away, but on things that you already do, right?
Yeah, and all I'm asking to is just shift where you're putting your money, right? If you're putting your money in Wells Fargo, by the way, just between Wells Fargo, Bank of America, and Chase, they have about $70 billion in it.
Right. They have their own policies.
I'm not telling you that this is something they have their own. So this is, I never knew why when I was younger. All my friends, they were like 20, 30 something years old. They were all VPs of banks.
Yeah.
Right. I'm like, how the heck are these guys VPs of banks? They didn't look like they were doing anything that important. And they all VP banks. The second they become a VP of bank, the bank takes out one of these policies on them.
Yeah.
Because now they're they're a key person. They're insurable interest. They're an executive. So anyhow, let's recap this real quick. Again, what were the key takeaways? Okay. I'm going to ask you as an owner. So imagine all those premiums you took over that time, bro. Your family's legacy would have been set. I lost, right? Where do they store their money? They store their money in liquid, safe assets that never lose money, like Warren Buffett. right?
Right.
They put it in, they put it in something designed. In our case, we're designing a custom designed, high dividend paying life insurance policy. So that way you could run all your money through there instead of putting it in your banking, writing out checks. For every dollar
Right.
you put in there, right, you have access to at least 90 something percent of it, but 100% of it is always making at least 3 to 4% interest plus dividends, right? It never stops. Number two, the banks, what do? They're doing the same thing. They're taking someone else's money. So as a business, you're taking the consumer's money, you're putting it in a safe, liquid environment. So, something happens, you're able to pay your people, and so forth. But now when you take it out, that money's all the money you put in there is making interest, and you've used it just like you would have used it before, except for every month you were bringing it down to not to zero, because you hopefully were making a profit. But if you were making 10% profit, right, each month, right, you would be making 10 grand that would be just sitting there in your bank making 0.5% interest. Then you got to figure out how to open up other agencies. You can lend it yourself. The next one is and so how do you go about it? You reach out, go to victorarocho.com. My calendar's there. Set an appointment with me, number one. Number two, in the link, I'm going to show you, there's a presentation. I'm going to give you access on how to reach me, and let's have a conversation. It's a whole strategy session. Number one is for me, I do business with anyone. I have a 90-minute video so you can understand it, because you really got to want to do this. And the problem is they don't teach you this in school, right? Think about it. The 401k, you get a job right out of college. First thing they do, oh, Andre, you're young. You could take risks, put your money in here. Well, I don't know about you, but my 401k has already dropped 14%.
Right.
Okay. And my poor in-laws, right? They're retired. They're worried every month that their 401k goes down. That's their money.
Right.
Here, you don't have to worry about it. And when you take it out, it's tax-free.
Cool. Okay. Looking forward to it, man.
Well, then you go in there. So any thoughts, anything changed for you based on what we originally talked about?
No, I like it. I think that it's a niche part of our life product. We're doing great with the FFL. What we're building there is really a strength to the agency. Like, we're working with income tax preparers that just had a tremendous season, and they're reaching out to the people that have mortgages, and they're reaching out to the people that have their own businesses. And in some of these cases, what you're talking about, it just totally makes sense especially for business owners, agency owners. I could think of already like 5 people that own their own agency that truly would benefit from this. And like you said, it's something that not everybody offers out there. So let's reach out to you, and looking forward to
Well, I appreciate your time. And how do people get a hold of you?
LatinAmerican@me.com, and go to lapa.work. That's our website, lapa.work. And looking forward to the next event, LatinAmerican@me.com.
Again, this is Victor VTV. Please stay tuned to my podcast. We're going to be talking about other things, having other entrepreneurs on. This is just one segment that I have a lot of passion on. And but we're going to bring on other entrepreneurs. I'm going to show you things on sales. We're going to talk about sports. I have a sports show every Thursday, Jersey Boys Sports Talk, at 8 p.m. Please join us there. But I am here to be able to continually giving you knowledge, and particularly for what I call the blue collar millionaire. I want to help as many people take back the function of banking, right? What we were taught is affecting us. And look what's happening in the country. For every dollar you have in the bank, look what inflation is doing. It's worth 7 cents less. Inflation's killing us. The price of gas is killing us. Stop letting other people make money. Fund your own stuff. God bless. Stay tuned. See you next time on Victor VTV. Thank you.
Pura vida.